In less than 18 hours, silver futures markets saw a sudden structural shift. Yes, only 18 hours, and the price of silver is completely flipping. I am going to break this down in plain language so you are not left behind. So stay with me, because this market changes quickly, and it waits for nobody. Here's the part you need to stick in your head. Exchanges eliminated an 8.5% emergency margin buffer, and that immediately expanded leverage capacity across billions of dollars in open positions. That move just changed the foundation beneath the market's surface. And shifts of this magnitude rarely happen without triggering second-order effects that unfold rapidly. This type of abrupt margin reversal does not normally occur after exchanges impose tightening measures exceeding 22% earlier this quarter to control volatility. These emergency policy reversals only happen when silver's leverage structure begins threatening broader market stability. And almost nobody is noticing that total futures exposure had already contracted by more than 31% over a 2-day span, leaving positioning unusually thin and highly reactive. Silver does not require massive capital inflows to move. It requires the sudden ability for capital to return. Futures markets operate on margin, which means participants control large notional positions with relatively small amounts of capital. When exchanges relax margin requirements, the same trader can instantly increase exposure without deploying new funds. Each standard silver contract represents 5,000 ounces, meaning even a modest increase of 40,000 contracts translates into 200 million ounces of synthetic exposure re-entering the system. This is how liquidity shifts transform directly into price volatility. This change is occurring while broader systemic liquidity conditions remain elevated. Reverse repo balances recently fluctuated near $412 billion, signaling that large pools of capital remain parked in risk-free overnight facilities rather than deployed into markets. When margin requirements fall, some of that sidelined liquidity can rapidly migrate back into leveraged assets like silver. The transition does not require new money creation, only the redeployment of existing capital into higher volatility instruments. At the same time, the physical silver market remains structurally tight relative to financial claims. Global silver demand exceeded 1.2 billion ounces last year, while mine production contributed only approximately 830 million ounces, forcing markets to rely heavily on recycling and above-ground reserves. This imbalance creates a fragile equilibrium where financial positioning can expand much faster than physical supply. When leverage capacity increases, futures exposure can grow exponentially even as physical availability remains constrained. This asymmetry explains why silver responds so violently to liquidity regime changes. During previous liquidity expansion phases, silver prices advanced more than 35% within 45 trading days, driven primarily by futures market repositioning rather than physical shortages. Liquidity expansions do not simply stabilize silver, they amplify its volatility profile. What makes this moment particularly consequential is the speed at which the transition occurred. Liquidity conditions did not gradually improve. They shifted overnight, altering the structural constraints that had suppressed speculative participation. When leverage capacity expands in a market where positioning has already been flushed out, price reactions become nonlinear. Silver does not ease into new trends under these conditions. It reprices abruptly.